right, lesson 8 is building and protecting your credit. So we're going to be talking about what is credit, types of credit, and how to build your credit. So credit is the ability to borrow money or access goods and services with the understanding that you will pay back the borrowed amount in the future, often with interest included. So this is not to be confused with debit. I know a lot of people think, oh, credit card is the same as debit card, but these two are not the same. So credit, as just stated, is borrowing money that must be repaid later. But debit is money that you already own. So the debit will be it will be linked to your bank account, and instead of paying money with your credit card, which is money that you don't actually have but you have to repay back later, debit's just the money in your bank account. All right, so here are 3 types of credit. Revolving credit credit cards are a good example for this. So you can borrow up to a set limit and repay at your own pace, but at least the minimum payment is required. So revolving credit could be linked with credit cards. Installment credit, this is used for loans like car loans or mortgages for houses, and this is borrowing a set amount of money and repaid in fixed monthly payments over time. And finally, open credit, and this is bills like utilities where you pay the balance in full each month. All right, here are some risks of credit. So you can run into debt, which we talked about before, and this is spending beyond your means that could lead to unmanageable debt. So be aware of that. Interest costs. So high interest rates can significantly increase the cost of borrowing. And finally, credit score damage, which we will talk about. Late payments or defaulting on loans could harm your ability to borrow in the future. So this kind of like a general term or a general summary of credit score damage, but we will get into that later. All right, here it is an example. So let's say that you want to buy a car. The brand new car is $20,000 and you can't afford to pay it at once in cash. So you may take out an auto loan for the $20,000 with an interest rate of 5%. Instead of paying for the car in full, you take out a loan and pay off the car with monthly payments over 5 years. May be the best option. So this is an example of credit in the form of a auto loan. So how to build your credit. Credit is on a scale from 300 to 850, and it's your credit score will not actually start at either 300 or 850. It's going to start somewhere in the middle. So it's going to allow you for the opportunity to raise it by making smart credit decisions or lower it by making bad credit decisions. So it's important to build your credit because it reflects your reliability as a borrower, impacting your ability to secure loans, credit cards, or even rent housing. And many people who are going to lend you money are going to look at your credit score, and they're going to see if your credit score is not very good, they might be hesitant or reluctant to offer you that money. So not only just receiving these, but also gaining lower interest rates, whether it's a mortgage or an auto loan or a credit card. So that's another way that credit is really going to come into play. So to build credit, we got 3 ways here. Consistently make on-time payments. Keep credit utilization percentage low, and we recommend about below 30%. So while you might be allowed to use a certain amount of credit, not using that full amount will show your credit card provider that, or not just credit card provider, but like any credit issuer, it will show that you're reliable. And avoid opening many accounts at once. These are all good ways to build your credit. I might swerve in that corner, whoa, whoa. Hold on tight, 'cause I tweaking this talent.